Have you ever been stopped out of a certain trade and then you watched price go in the direction that you intended? That was not bad luck. That was a liquidity sweep, and let's break it down. So let's first explain what a bullish liquidity sweep is. So for a bullish liquidity sweep, you're going to be wanting to be focusing on previous swing lows. For example, this swing low right over here. So below this swing low, right? For the traders who are longing this stock, so they think the stock is going to go up, they have their sell orders at the bottom of this swing low or their stop losses, right? But also below this swing low, you have traders who are trying to short that stock. So you're going to have orders below this swing low. When price gets below it, traders who want to short the stock and take the stock downwards. So you have two types of orders below this swing low. You have stop losses and sell orders for people who want to take this stock downwards. That is why price is so attracted to those areas, because price wants to fill those orders. So big institutions wait for those sell orders to be filled, and then they can take the stock upwards. So what should you do if you're bullish on a play? You don't want to be caught up in that initial wave of traders that get stopped out. That is not the goal, right? What you want to do is observe major swing lows and then wait for liquidity to be taken, right? Once liquidity is taken and you're starting to see a reaction, then you can add a confluence like a fair value gap or an order block to then take the stock higher or long whatever position that you're trying to get into. Now let's explain a bearish liquidity sweep. For a bearish liquidity sweep, you want to be paying attention to previous swing highs. So for example, we have this swing high right over here. Now above this swing high, you got to remember, they're not only stop losses for people who are trying to short the commodity, but there's also buy orders for people who are trying to take the stock long if they see a recovery. So what should you do as a trader? You should wait for liquidity to be taken, wait for a reaction, and then add a piece of confluence like a fair value gap or an order block, and then take the stock down or short the commodity. Now let's look at a couple of examples on a chart. So right now we're looking at the MNQ chart or the micro NASDAQ chart. And look what happened as soon as we swept this sell side liquidity, right? So we have this major low over here, right? That price was able to sweep. And look what happened once price swept this sell side liquidity. We had a major reversal all the way up. Now for this example, we're looking at the Russell chart. And what are you guys noticing? We have this major swing high right over here, right? So this swing high was a major level that we ended up sweeping over here. And look what happened as soon as we swept that swing high. We had a breakdown and price reversed in the opposite direction. So it's always important to be paying attention to certain swing highs and swing lows on your chart, because those are potential areas where orders are waiting to be filled and where liquidity is waiting to be swept.